In the face of widespread corruption by U.S. businesses, Congress passed the Foreign Corrupt Practices Act, otherwise known as the FCPA, in 1977. The Act protects against unethical behavior and provides a level playing field for all businesses interested in foreign trade. In many countries, bribes and kickbacks given to government officials are commonplace. These behaviors threaten market growth and limit the opportunity for honest business owners to go into or expand their businesses. Bribery and other unfair practices also inflate the cost of doing business, thus affecting the economy overall. The Act requires all U.S. businesses, regardless of size, to be forthright and honest in their dealings in international trade. The law has two main components: anti-bribery and accounting. The FCPA makes it illegal for businesses or individuals to order, offer, or assist another party in giving bribes or kickbacks to foreign government officials to gain a business advantage within a particular country. Bribes in the form of monetary payments, travel or entertainment benefits, charitable contributions, and any other gift of value are strictly prohibited. The Act makes it illegal to promise bribes or kickbacks, even if they are never actually given. In addition, bribes that do not result in an unfair advantage are still illegal. Intent is the most important test of the law. In addition to officials directly employed by foreign governments, the law covers individuals working in an official capacity for the government, such as consultants, advisors, or university employees. In many countries, businesses that are traditionally private organizations in the United States are actually run by the government. Often, officers of these organizations are also government officials. Doing business with these organizations is high risk and should be monitored carefully. Complying with the FCPA is required whether conducting business on U.S. soil or abroad, and it applies to any company representative, including its owners, directors, board members, and agents. Foreign companies or individuals who engage in bribery schemes within the United States may also be prosecuted under the law. This includes the use of interstate or intrastate communication to facilitate the crimes. The Facilitating Payments exemption was written into the law for payments made to lower-level officials whose duties are clerical in nature. The payments, often referred to as grease payments, are intended to speed up or facilitate routine governmental action. In recent years, however, the Department of Justice and the SEC have advised organizations to prohibit or discourage these grease payments. Therefore, most companies now avoid them entirely. Third parties represent the greatest risk for violations of the law and represent 90% of the FCPA cases brought by the U.S. government. A third party is any company or individual who assists businesses in a foreign country. Third-party agents should be thoroughly vetted, and every contract should include an FCPA policy. High-risk third parties include sales agents, lobbyists, joint ventures, distributors, and resellers. In addition, foreign attorneys are some of the most dangerous third-party agents. In many countries, the legal system is dangerously corrupt, and bribes are normal practice. Legal proceedings in at-risk countries should be closely watched. Clear, concise communication is critical. Often, words like commission will be substituted for the word bribe. In most cases, corrupt practices will not be spoken about directly. It is vital that all third-party agents are closely monitored and that FCPA policy is followed to the letter. To protect business investors, the FCPA requires publicly traded companies to keep truthful and accurate records so that corruption may be more easily detected. This includes the disclosure of all assets and liabilities, as well as filing annual financial statements with the Securities and Exchange Commission. To ensure compliance with this rule, each company must follow internationally recognized and accepted accounting procedures, otherwise known as GAAP. The Department of Justice and the SEC use a variety of investigative tools to find FCPA violators, including sting operations and collaborative efforts with other agencies, such as the FBI. Investigative journalists also play a pivotal role in regulation by uncovering stories of bribery and corruption. However, the majority of violations are uncovered by professional consultants, such as accountants or lawyers during corporate reviews. Organizations who report violations voluntarily to the Department of Justice or the SEC generally receive more lenient treatment by authorities. Violations of the FCPA can result in a number of severe civil and criminal penalties, including fines and imprisonment. Violators may also be found guilty of breaking other laws, such as anti-money laundering or wire and mail fraud statutes, all of which could result in additional penalties. Furthermore, violators might be prohibited from participating in future international business ventures, either temporarily or permanently. The bill allows for the prosecution of companies. However, an individual employee or agent can also be prosecuted, regardless of a company verdict. Around 50% of FCPA cases open today are against individual business persons or agents. The U.S. government rarely loses FCPA cases. In fact, several major U.S. corporations have lost hundreds of millions of dollars in penalties and fines in recent years. Corruption and unfair trade practices harm the economy and stifle innovation and creativity. They give an unfair market advantage to dishonest individuals and companies and represent a barrier to entry into the marketplace for ethically run businesses. Following FCPA law is not only a business imperative from a legal perspective, it is also the right thing to do for the prosperity of our country and world.